Welcome to Group Insurance Daily Pulse, your concentrated dose of the latest market intelligence. I'm Aria the Actuary, dissecting the P&L, regulatory implications, and solvency considerations of the past 24 hours.
And I'm Dorian, the distribution expert, translating those shifts into actionable strategies for market share growth, ROI optimization, and enhanced employee experience. We cut through the noise to bring you the core data driving our industry.
Today, we're diving deep into three critical developments: Guardian Life's significant increase in claim settlements, Aflac's strategic enhancements to its voluntary benefits portfolio, and WTW's advancements in actuarial modeling, coupled with crucial cyber claims insights.
Let's jump straight into the data. First up, Guardian Life's Q1-Q2 2026 claim settlement report.
Dorian, give us the headline.
For us,
Staggering is an understatement, Dorian. A 34.3% increase in settled claims is a significant delta.
Aria, the context provided points to an expanding customer base and a diversified insurance portfolio.
While expanding customer base is positive for market share, it requires stringent underwriting.
are we seeing shifts in morbidity or mortality experience within these new segments? Is there any indication of adverse selection being masked by aggregate growth? The split between 23,740 death claims and 104,259 health claims is crucial. These demand entirely different actuarial assumptions, reserve methodologies, and volatility profiles. The aggregate number, while impressive for market optics, requires disaggregation for a true actuarial assessment of risk exposure and pricing adequacy. And under IFRS 17, this increased volume and speed of settlement necessitates precise measurement of the contractual service margin and timely recognition of claims incurred. We must ensure that the financial reporting fully reflects these dynamic liabilities.
Aria, the market rewards carriers who can deliver on their promises, especially in high-volume scenarios. Guardian's ability to promptly settle over 130,000 claims in 6 months reinforces its position as a preferred partner.
This isn't just about operational metrics. It's about a tangible impact on employee financial wellness. Employers want to offer benefits that work when they're needed most. This performance directly contributes to a stronger employee value proposition, aiding in recruitment and retention. The digital investments are foundational to scaling this trust, leveraging technology to manage risk through better data insights, not just faster processing. It's a strategic move for long-term market leadership. From claims volume, we pivot to product design. Dorian, let's discuss Aflac's 2026 enhancements for group accident, critical illness, and hospital indemnity plans. What are the key takeaways for our listeners?
Aflac has made significant enhancements to its group accident, critical illness, and hospital indemnity plans for 2026, primarily through higher payout amounts across various benefits. Specifically, the group accident insurance plan now offers increased payouts for initial treatment, burns, lacerations, fractures, dislocations, and physical therapy visits. The group critical illness insurance plan sees higher payouts for coronary artery bypass surgery, non-invasive cancer, skin cancer, and several childhood conditions. And their group hospital indemnity insurance features higher payouts for hospital admission, confinement, and intensive care.
Higher payout amounts directly translates to increased expected claims costs, and without proportional premium adjustments, a direct impact on profitability. My immediate question is the underlying actuarial justification for these increases. Are these enhancements funded by premium rate adjustments, or are they being absorbed by margin compression? This impacts the P&L directly. We must evaluate the potential for increased utilization, particularly for benefits like physical therapy or non-invasive cancer, where the perception of richer benefits might influence claim frequency.
Aria, this is a strategic investment, not merely a cost increase. Aflac is acutely aware of the market's demand for more robust financial protection against rising out-of-pocket healthcare expenses. The ROI here is multifaceted: increased market penetration due to a more compelling product, higher persistency rates as policyholders perceive greater value, and stronger brand loyalty. For employers, these enhanced supplemental benefits are a cost-effective way to bolster their overall benefits package without impacting core health plan premiums.
Strategic investment is a euphemism for increased liability if not priced correctly. How precisely are these higher payouts being funded?
Are we seeing a resegmentation of risk pools to isolate and manage the increased exposure? Or is this a broad-based rate adjustment across all insureds? And the impact on statutory and GAAP capital requirements cannot be overlooked. Richer benefits, by definition, imply higher future liabilities and thus potentially higher solvency capital. We need clarity on the revised pricing methodologies, including any adjustments to experience rating formulas and the impact on embedded value calculations for the block of business.
The market is dynamic, Aria, and Aflac is demonstrating leadership by proactively evolving its offerings. This move sets a new benchmark for voluntary benefits, compelling competitors to reevaluate their own portfolios. It creates a more robust, employee-centric benefits ecosystem, ultimately driving increased adoption and engagement across the group insurance landscape. Brokers gain a powerful tool to differentiate their service, offering comprehensive solutions that address the holistic financial well-being of employees. This isn't just about higher payouts. It's about a commitment to value that resonates deeply with both employers and their workforces, leading to sustainable growth and deeper market penetration.
Our final yet equally critical development comes from WTW, addressing actuarial modeling and cyberclaims insights. Dorian, walk us through their technological advancements and the implications of their latest cyber report.
Willis Towers Watson is pushing the envelope, Aria, by integrating GPU execution into its flagship actuarial modeling platform. This signifies a major leap in technological advancement for risk management and pricing efficiency. Concurrently, their Willis business has released a comprehensive report analyzing 5,500 cyberclaims from January 2013 to January 2026, totaling approximately $1 billion in insurer payments across 95 countries. Key findings include over 95% of average data breach losses and 90% of average first-party losses are adequately covered by insurance. However, ransomware events average 25 days of disruption, with an average loss of $5.3 million, though the largest single loss exceeded $500 million.
Crucially, the report notes that artificial intelligence is fueling risk volatility by amplifying existing threats, rather than being a standalone driver of cyberclaims. This combination of advanced modeling and critical insights allows carriers to refine cyber insurance offerings and assess emerging risks, while empowering brokers to advise employers on the adequacy of their coverage. GPU integration is a computational enhancement, not a fundamental paradigm shift in actuarial principles. While faster execution is beneficial, the robustness of the underlying models remains paramount. Are we seeing enhanced stochastic modeling capabilities for extreme tail risk, or simply faster execution of existing deterministic models? Garbage in, garbage out, regardless of processing speed. On the cyber report, over 95% adequately covered sounds reassuring, but the fact that the largest single loss exceeded $500 million is a critical outlier. How are these extreme tail events being priced and reserved for? The non-stationarity of cyber risk, amplified by AI, presents significant challenges for traditional actuarial methodologies and capital modeling. Are capital models adapting sufficiently to this rapidly evolving fat-tailed risk profile?
Aria, the speed and efficiency gained from GPU integration aren't just about faster calculations. They enable more granular segmentation, real-time scenario analysis, and dynamic pricing, leading to more competitive and accurate quotes for group insurance products. This is critical for managing complex risks like cyber. The cyber report provides actionable intelligence that allows carriers to refine policy language, develop new risk mitigation services, and offer more robust group cyber solutions to employers, a rapidly growing demand given the increasing threat landscape.
While granularity is desirable, the fundamental challenge remains the predictive power for novel and rapidly evolving threats. AI amplifying existing threats means the risk landscape is evolving faster than traditional actuarial cycles. How are these models incorporating real-time threat intelligence, and how are the parameterizations being updated dynamically? What are the regulatory implications for data privacy and security within these advanced modeling platforms, especially for carriers holding vast amounts of PII? The stark contrast between the $5.3 million average ransomware loss and the $500 million outlier highlights the extreme fat-tailed distribution of cyber losses, which traditional capital models often struggle to capture.
This isn't just about speed or theoretical modeling area. It's about a more resilient and responsive insurance ecosystem. WTW's advancements position its carrier clients at the forefront of risk innovation. For brokers, it means access to superior tools for analyzing client risks and advising on complex benefit structures, including critical cyber risk considerations for the group. For employers, these advancements can indirectly lead to more tailored and cost-effective group insurance solutions. The report underscores the persistent and evolving nature of cyber attacks, driving demand for comprehensive risk management and, crucially, ancillary benefits or support services that address the employee impact of cyber incidents.
It's about managing the known and preparing for the unknown with better data. Complexities abound, but the drive for efficiency, robust risk management, and precise liability measurement is clear across the group insurance sector.
And the market's continuous push for innovation, enhanced employee value, and responsive product development is undeniable.
That's all the time we have for today's Group Insurance Daily Pulse.
Join us next time for more data-driven insights.